Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Meta agrees to deploy millions of Nvidia processors over the next few years, reinforcing its ties with the AI chip giant. Plus, Meta's CEO Mark Zuckerberg is set to take the stand later today in a landmark social media addiction trial in Los Angeles. And we discuss some news in software and energy tech with the CEOs of Autodesk and Heron later this hour. Welcome to Bloomberg Tech. The story right now in public markets when it comes to tech is we are rebounding a little bit. The Nasdaq 100 up more than a percentage point. Largely that's on strong or positive economic data. But I put the Philadelphia Semiconductor Index in there, or SOX, because actually movements in chips and the Mag 7 is the news driver, the catalyst in some of what's happening at the index level. That manifests in a deal between Meta and Nvidia for millions of Nvidia's processors over a number of years. But this is clearly a driver of markets, at least in Nvidia's case, up almost 3%. Meta had been lower, is now modestly higher. Let's get the details of Bloomberg's Ian King, who leads our coverage of semiconductors. So the reality is, Meta's already the number 2 customer for Nvidia, but this is an agreement over time, millions of chips, and we're not just talking Blackwell GPU, we're talking later generation Rubin, and then the CPUs in each case. What are the kind of facts that we need to know?
Yeah, and networking as well. I mean, the frustrating part about it is we don't have a definitive time period, but if we sort of back it out, 1 million chips, their average selling price for Nvidia of one GPU for the data center is about $15,000, $16,000, probably as much as twice as that for a leading edge one. So you're already talking as much as Meta spends on Nvidia gear in a year in just the GPUs, add on top of that the networking, add on top of that the CPUs, and obviously it feels like an extension, it feels like a bigger commitment to Nvidia, right, but they wouldn't say for sure.
You had a discussion with one of Nvidia's leaders in the data center and infrastructure group, and part of the discussion was this is the first big example of Nvidia selling the Grace CPU to market as a kind of standalone product. Simple question is, like, what would you use a Grace CPU for, other than what's happening in AI? And that is why the number is probably tens of billions over that time period, right?
Yeah, I mean, it's definitely a step forward for them. It's definitely a market expansion for them. And you remember Jensen told us this
yes,
a while ago. He dropped a strong hint that this was coming, and here it is. The key thing to look at is this is Intel's territory. This is AMD's territory, the general purpose processor for a data center that does a lot of the general computing tasks. What Nvidia is saying, hey, we've got this CPU that was buried in the middle of all of this gear, but you can just use it on its own as well. That's a market extension for them if we see widespread adoption. Obviously, Meta is a good adoption case.
One of the other movers in the market this morning is AMD, which was to the downside. I guess not surprising. The biggest story is Nvidia kind of keeps rolling on and dominating the spend of the hyperscalers plus Meta, which is not a hyperscaler, but that has the data center footprint of one. I was interested to go into the terminal and see, like, Meta, about 9% of revenues for Nvidia. But Microsoft's number 1, double that. But the big picture is there, right? Nvidia, it seems dominant.
Yeah, I mean, the background here is Microsoft, Meta, Amazon. They're all making their own CPUs. They're all trying to make their own accelerators. Any commitment to either Nvidia or indeed AMD for exactly those parts is obviously something that investors want to see and is a strong sign for the chip makers themselves.
Bloomberg's Ian King on a story that, again, news-driven catalyst for markets this morning. Investors are looking also to scoop up beaten-down names after a stretch of choppy AI-driven volatility. Morgan Stanley says the recent sell-off, especially in software and services, was largely indiscriminate, with some companies hit harder despite strong fundamentals. Here to break down the AI impact across all sectors is Morgan Stanley Global Research Director Katie Huberty. I mean, it's such a detailed report that looks across stocks with a very wide lens. But in the here and now, I want to go to that word indiscriminate and just that paragraph of the report where you summarize the last few weeks. What do you think was happening?
Right. Right. So I think it's important, and on the back of the announcement that you just discussed, to understand that we're in the very early innings of what is likely to be a $10 trillion CapEx investment cycle. That investment cycle is underwritten by a productivity story. As the technology diffuses into the market, there is real productivity acceleration, which is important because the last 2 decades, we've been running at labor productivity that is half of normal levels. Because we knew this adoption story was going to be critical and it was going to touch all sectors of the market, we have now 5 times over mapped the 3,600 stocks that we cover to understand rate of change, exposure, materiality, pricing power. And it's on the back of that data that, yes, we've been able to identify where there are companies that have been sold indiscriminately, and there's a real opportunity. We see that in software and services. In research, we're a heavy adopter of AI technology. And the conversations we're having right now with large language models is how do we connect those models to the applications and data that we use every day to unlock the real potential. And so you can see that, the list that we published last week, the thread across the software and services companies are where there is a data moat, whether that's credit or it's market data or it's systems of record in financials or customer data.
This is the 5th time you've kind of done this exercise of mapping global AI stocks, right? And you list margin expansion as the leading piece of evidence of ROI. I'm thinking back to earlier in earnings season when we had names like Salesforce, ServiceNow, and that part of the research report I flagged at the beginning, fundamentals. They didn't really get the benefit of the doubt from the market. They showed actually quite a lot of real-world deployment of that technology. But something isn't quite believed by the street. What is that?
So what's really important in this data set is tracking rate of change. So if you go back 2 years ago, the big rate of change in exposure materiality was energy and utilities. That sector outperformed the most in 2024. Last year, it was financials. At the beginning of 2025, we highlighted as the biggest rate of change. Financials, by many accounts, even outperformed parts of the technology sector last year. Right now, the rate of change is actually greatest in non-tech categories, particularly in consumer and apparel, in durable goods, in autos. And so, yes, we see areas of software that have been sold indiscriminately where there is a data moat and there's an opportunity, but it's broader than just technology. What we see in the data is that the AI adopters are experiencing margin expansion that's double the market indices, double the MSCI World Index, double the S&P 500. And so we believe that there's a regime shift happening in the market away from a purely tech and specifically AI enabler leadership to now broadening of AI adoption and leadership, not just in technology, but across all sectors.
Katie, tied to this, one of the big moments of last year was Morgan Stanley launching its private companies coverage, going much deeper on private companies who are so active in this world, right? Have you shifted existing analysts from public to private companies? Are you onboarding specific private analysts on specific domains? We just have 30 seconds.
Right. So we believe that the domain experts that cover the public companies are typically and best positioned to also cover private sectors. But there are areas of thematics, think humanoids and AI, where we have shifted analysts from stock coverage to covering those thematics, where there will be a lot of private company innovation. But most of the time, that coverage comes from our existing public company domain experts.
Katie Huberty of Morgan Stanley, it's great to have you on Bloomberg Tech. Thank you very much. Now, coming up on the show, we're going to speak with Andrew Anagnost, Autodesk President and CEO. That conversation's next. This is Bloomberg Tech. Autodesk is leaning into the AI-powered physical world. The company announced a $200 million strategic investment in AI research firm World Labs, its largest startup investment to date. Here to discuss, Autodesk President and CEO Andrew Anagnos. Very
morning,
interesting. Good morning to you.
Very excited about today.
We've been looking into this idea a lot, through the beginning of 2026, particularly in the context of industrial manufacturing, the future role of humanoid robots, how they come to learn the environment that they're in. People sometimes say digital twins. You have chosen what you believe to be the best player, right, for the sort of AI and software underpinning of that. To start, why World Labs?
Yeah, well, there's a couple of really important reasons. First, we kind of share a common ethos. We believe that AI can enhance and expand human ingenuity, not replace it. And that's something that both World Labs and Autodesk share in common. But more importantly, Fei-Fei Li, Autodesk, others believe that the next frontier are world models. This is the ability to simulate, predict, and react to real-world constraints and virtual changes in real-world constraints, virtual changes of design constraints within a virtual environment. That means you really have to partner with someone that's got deep expertise in spatial reasoning for AI. That's why we picked working with World Labs, and they picked us because we have deep expertise and deep data knowledge of what happens in a design and make process.
The technical challenge is to apply the physics of the real world into the virtual world, particularly when you're trying to simulate. I'm assuming that beyond the investment, there is a commercial arrangement here, right, where you're able to do something with World Labs technology. How does that manifest?
Yeah, so we're going to be working together with using World Labs technology with our tools. They're also going to get access to some of the proprietary models that we've built so that we can help them expand and create their ability to do deep spatial reasoning. So you'll see us initially lean into the media and entertainment space, but as you said, this is much more expansive than that. At Autodesk, we're really interested in the mid-market manufacturing space and mid-market factories, small and mid-sized factories in particular. This is going to be a high growth area, and these factories are going to need to be able to operate like the biggest factories in the world, but at a much smaller scale. And they need technology from us and technology from World Labs to do that.
You put out the announcement about the $200 million part of the strategic investment. Actually, later in the morning, World Labs confirmed they did a $1 billion fundraise overall. So you're a big portion of it. What was the valuation that World Labs was assigned in that?
You'd have to talk to World Labs about that. I'm not going to discuss what their valuations were, but you can reach out to that team.
The question is, when does this become a real commercial opportunity for you then, Andrew? When is it that you're going to be able to say in an earnings report, this is something that resulted from that strategic investment?
It's important, Ed, for us to recognize that in our space, AI is already returning value. I know there's a lot of hype out there, especially with the infrastructure buildup and what's happened with large language models. But a lot of software companies, particularly Autodesk, have been investing in AI incrementally for a decade. So we're already delivering value today around the ability to simulate certain things like flooding, lighting studies, the ability to simulate air and wind and noise studies using AI, the ability to build preliminary models with AI that take into account structural constraints or the need to remove structural constraints, and helping people make better decisions in the construction cycle. So AI is delivering value in our space today. And regardless of what happens out there in the world, we're going to continue to invest over the next 2, 3, 4, 5 years. So you'll see us continue to roll out incremental real value. So it's happening now. This is only going to allow us to accelerate deeper value into additional areas and into deeper parts of the design and make lifecycle.
That's where I want to end it. A lot of people ask, what's the net result of all of this? We focused a lot on digital twins, virtual worlds. We've discussed that. Is the result that big facilities, manufacturing sites, plants get built quicker, the people inside them get trained more quickly, humanoid robots are deployed in the real world more quickly?
Here's the big story in our space, Ed. There is a massive capacity problem. There's not enough money, people, and materials to build and rebuild everything in the world right now. Right now, people are building lots of data centers, a lot of infrastructure that serves day-to-day people in their lives, road, rail, all sorts of things, doesn't get built while that's getting built. We need to execute more projects with the same amount of people and the same capacity we have today, and we need to do it at an accelerated rate. That's something that's very unique about the design and build world, this fundamental capacity problem. AI is going to be an enabler to unlock that.
Andrew Anagnos, Autodesk CEO, really appreciate your time on Bloomberg Tech. Thank you. In other earnings news, Palo Alto Networks shares plunging, having a difficult day after the cybersecurity company released a forecast for adjusted earnings that was weaker than anticipated, though it also boosted its full-year forecast for other key metrics, including revenue and remaining performance obligations. CEO Nikesh Arora told us why he thinks the market is wrong about its reaction to the earnings. Listen to this.
I think the market is not paying attention to our numbers carefully. We just completed our largest acquisition in CyberArk. We had a great quarter. Our numbers are across every known consensus metric. The market is not understanding that our guidance for the next 2 quarters includes CyberArk. If you take the consensus of CyberArk and ours, we're actually getting above the collective consensus, but the market hasn't understood the dilution of shares, so I think they have it wrong.
Coming up, Apple fast-tracks AI wearable devices. We have the Bloomberg reporting next. This is Bloomberg Tech. Jeff Bezos' space startup Blue Origin has shifted resources from space tourism to lunar projects. CEO Dave Limp spoke with Bloomberg's Anne-Marie Hordern about the move while at the Defense Tech Summit.
Where it's such a pivotal moment around where space is, and there's never been more demand. We have years worth of demand for our launch business, as does everybody that's launching. We're very constrained as a country in terms of the number of launch vehicles that we have right now, and our adversaries around the world are not standing still. They're putting hundreds of billions of dollars into launch and into space, and especially as it relates to the moon. Which, we haven't been on the moon for 50 years. We think it's really important for Blue, for the country. And it just made prudent sense from our standpoint to take the brilliant people that we're working on New Shepard, pause that for a while. We're planning for at least 2 years. And then repurpose them to even further accelerate our efforts in lunar and launch.
There was all this excitement, I think, about New Shepard, especially because Katy Perry went to space, and for civilians who maybe want to have that moment like Mark Bezos had. So do you think you'll go back to that at some point? Is it really just a pause?
I think we will. I think there's still, we had multiple years of backlog, and that it was the easiest ticket to sell was that. And so I think we'll likely go back into that business. But again, at the moment in time right now, it just makes more sense to focus on the moon.
So it really is a space race right now.
I don't, I'm very much pro-America and a capitalist, but I don't think we want another Sputnik moment. And we were the first to put boots on the moon, and I really feel like we want to put boots on the moon. And this time, the name of our group inside of Blue is Lunar Permanence. So we're not only racing to the moon to get there back again for the first time, but we want to keep people on the moon.
Blue Origin CEO Dave Limp speaking with Bloomberg's Anne-Marie Hordern. In other news, it's time for Talking Tech. And first up, Warren Buffett's Berkshire Hathaway cut its Amazon stake by 75% in the fourth quarter, reducing it to about 2.3 million shares, according to a regulatory filing. At the same time, it built a new position in the New York Times with 5.1 million shares and continued trimming, according to the 13F document, its other holdings in Bank of America and Apple. Plus, Uber plans to invest more than $100 million to expand fast charging infrastructure for autonomous EVs in the US. The company will build high-capacity charging hubs in San Francisco, Los Angeles, and Dallas, the same markets where it's preparing to roll out a public robo-taxi service. And Apple is breaking away from its tech peers. Bloomberg data show the iPhone maker's 40-day correlation with the Nasdaq 100 has dropped to its lowest level since 2006, as it largely sits out the AI arms race. With rivals pouring money into AI-related capex, some investors are starting to see Apple as an appealing alternative. Let's power on and stay with Apple. The company's fast-tracking work on 3 new wearables as it races to compete with AI-powered hardware. Sources say the tech giant is developing smart glasses, a pendant, and AirPods with expanded AI capabilities. Bloomberg Consumer Tech and Apple managing editor Mark Gurman broke the story and is with us. Okay, 3 distinct products, 3 distinct categories. Let's go through what you've learned from sources.
You know, Apple, they are sitting out the AI race in a way, but they're going to enter in an Apple way. And that means hardware blended with AI, blended with software, blended with services. And they're going to get there if they're able to pull off this new Siri, which I believe they will before the end of the year. And so 3 hardware products. One is smart glasses. These are going to be quite significant. They're going to compete with the Meta product. They're likely going to be a bit pricier. They're going to have dedicated cameras, one for media capture, one for computer vision. In terms of functionality, you'll get things like if you're taking a walk and you have turn-by-turn directions on, instead of it telling you make a right in 450 feet, it might say make a right at the gray building because it sees your surroundings, or make a right past the white car. AirPods with cameras, very similar AI functionality without the media capture functionality built into the earbuds that people already know and love. And then the pendant, that's really an alternative product. That is an accessory for the phone, your eyes and ears for the phone, for AI in a sense. Similar functionality to the glasses and the AirPods, but not everyone wants to wear smart glasses. And so if Apple wants to provide that eyes and ears to the world, it's going to need some other product. And that's what the pendant's for. People aren't going to have AirPods in their ears at all times. People aren't going to want to put glasses on their face in all cases, especially if they don't have vision correction needs. So you need some sort of pin or necklace. And so that's what they're developing as well.
Just 15 seconds, Mark, literally, but do these come this year? When do they get released?
I would expect the glasses and the pendant to be released next year, and the AirPods as early as this year.
Bloomberg's Mark Gurman, who leads all our consumer tech coverage. Thank you very much. Now, coming up, we hear from San Francisco Fed President Mary Daly, her take on how to track AI's impact on the US economy. That's next. This is Bloomberg Tech. Welcome back to Bloomberg Tech. If you're just joining us, I kind of want to give you a flavor of what equity markets look like right now. And tech is giving us a boost, right? We're up 1.3% on the NASDAQ 100. You have about 79 names higher, 22 names lower. And it's a little bit of a rebound in the moment from the sell-off in recent weeks, driven by software and software anxiety. But beyond that, I also threw up US 10-year yield a little higher, basically 2 basis points, because, well, it's been a while since we showed you the bond market, and I like to keep things fresh. That's kind of what the public market story is right now. There's also some interesting stuff going on in private markets. And actually, the team at Bloomberg News do a really good job at going into those markets, looking at the documents, and finding out stuff that actually all markets want to know. Sally Bakewell leads our finance team. And in this case, the reporting is about what we know from sources, from some of those private names in software who are coming to us a little bit earlier than normal and saying, here's what's under the hood. Here's what we're learning. Just explain the reporting to us.
Yeah, that's exactly right. So these are private firms. They are owned by private equity firms, which obviously borrowed in order to buy them. So these are companies, software firms that have bonds and loans outstanding. Now, a lot of debt tied to software has sold off in recent weeks, particularly software as a service, because investors are very worried about the threat of AI disruption, potentially supplanting some of those tasks. So we have seen billions of dollars of loans tied to US software and US tech slipping into distress territory. Now, amid all of this concern, we have had a couple of private software firms actually opening their earnings books a little bit early to investors in a bid to calm nerves, to say that our earnings and our revenue are trucking along just fine. So we had the likes of McAfee, which showed that its Fourth quarter revenue held steady at about 626 million compared to the year earlier. We had Rocket Software, which actually saw a 5% increase in 2025 revenue. And we had Perforce Software, which actually saw a slight decline, but it was just a slight decline. So the aim here is to say we're software firms, but we are actually benefiting, or we are handling, or we are dealing with the AI threat.
Just before we start the conversation, the team in New York indulged me, really, going to the Treasury market. This is quite an interesting opportunity to go to corporate credit and some of the unsecured bonds tied to those case studies, because there's some reaction, right? Like the companies tell them something. We don't normally do this, but how did the bond market react?
Right. Well, I mean, a lot of this debt is actually senior secured, which means it is backed by collateral. It is high in the repayment line. They would have to see really significant impairment to experience any losses, or significant losses. So this is one of the arguments that the private credit industry is coming out with at the moment in defense of software, saying, our software loan books look good. In fact, Blue Owl Capital said it wasn't seeing, let alone red flags, it wasn't even seeing yellow flags in its software loan portfolio. And we've heard the same sort of sentiment from a number of them, and also saying that it's a bit too early to see any degradation in software right now.
Bloomberg's Sally Bakewell, thank you very much. We've spent a lot of time on the impact of AI on specific stocks. What about the macro picture? San Francisco Fed President Mary Daly says monetary policy makers need to be open to signs pointing to how the new technology could be changing the U.S. economy. Listen to this.
In productivity numbers, especially when they're happening in what I would think of as real time, it's very challenging to assess or draw it back to exactly what the factors are that have shaped it. In fact, people still don't agree on what happened in the 90s all the time, if you look at research. So it's just something to keep in mind. So then what you do, what any good economist or person, any industry person would do, is they'd say, well, what am I seeing? What am I seeing? And so right now, while we can't find it in the macro studies that would do very sophisticated empirical econometrics and ask the questions, how much of this is AI, we still can see that there's something going on there. The question isn't, is it happening? The question is, how long will it persist? Mm-hmm. And so clearly something's happening in the economy, but if you make a series, to go back to your question about productivity, if you make a series of one-time adjustments, so say you automate a production line, or you use AI to help in loan application process, you save money once. You don't save money forever. And I mean, you keep saving that money, but you don't get growth out of that. You don't get productivity growth. You get one-time adjustments to the level of productivity of your employees or your process. So what we're looking for is a technology to give us consistently good changes in productivity so that all industries at scale get better, industries figure out new ways to generate revenue, new ways to do product design, new ideas to come and shape the economy. That's the thing that has a sustained productivity growth part. So it's undeniable productivity growth has gone up. What's not as clear is how long will that last.
That was San Francisco Fed President Mary Daly. Abu Dhabi's MGX is pouring billions into its AI bets with no plans of slowing down. Since its launch in 2024, the fund has already invested in AI startups, chip makers and data centers, with plans to raise an additional $30 billion for infrastructure. Although fears of a potential AI bubble rise, the fund and its investment chief remain unfazed. Here with the details, Bloomberg senior tech editor Mike Shepard. We've been taking a very close look at the Gulf generally, but MGX is an example. And in part, our reporting is based on a conversation with that investment chief. What do we need to know?
Well, that's right. Our colleagues Mark Berg and Dinesh Nair sat down, and this was really the first of its kind interview with their AI investment chief, Ali Osman, and their chief strategy officer, David Scott. And they got a look at the inner workings of this firm, MGX, whose name is really showing up more and more, Ed, with all these AI-related deals that we've been talking about. Let's go to Anthropic. MGX was a co-lead investor in the latest fundraise. The company has also invested and taken stakes in xAI and OpenAI, really giving it, in a way, the triple crown of AI investing. And there's more. They've also put money into the big Stargate AI data center venture here in the U.S. and also taken a stake in the new TikTok that we've spent so much time talking about. So MGX is really a player in so many of these different areas. And one thing that struck me, Ed, during the interview and reading the big take on this was that David Scott likened their approach not to a private equity firm or a venture capital fund, but really to Nvidia, which you and I have seen from the conference here in Washington in October, just how much Nvidia has tried to take stakes in cloud computing and software companies that try to feed the ecosystem of artificial intelligence. And this is just a sign of how Abu Dhabi, whose sovereign wealth fund backs MGX, is really trying to diversify its economy away from just energy and try to seize on the AI wave now.
That's Abu Dhabi. The other news headline of the morning was Saudi Arabia's Humane disclosing that it had participated in xAI's Series E round, which predated the merger with SpaceX. What do we need to know there?
Well, this is another key tie-up between Humane, which got its start just last year. The Saudis unveiled Humane, which is backed by the Public Investment Fund. Again, we have state-backed Gulf money going into this new AI venture. It was announced just as President Donald Trump arrived in the Middle East for a high-profile visit, high-stakes visit with Gulf leaders. And they are now deepening this partnership already. In November, Humane announced with xAI that it would develop a 500-megawatt data center in Saudi Arabia, and this just furthers that partnership. And as a result of this investment, of course, they end up now with a stake in the much larger combined SpaceX, which now counts xAI as a subsidiary. And Humane is also looking to deploy more of xAI's technology, including the Grok chatbot, across Saudi Arabia, giving Elon Musk access to a key market that it could see develop going forward, and of course, possibly more access to funding as his larger combined venture moves forward.
Bloomberg's Mike Shepard, thank you very much. Now, coming up, Drew Baglino, CEO of Heron Power, joins us to talk about the energy startup's latest funding round. He may be a familiar face and a familiar name, of course, long-time Tesla executive, now in a new domain. That's next. This is Bloomberg Tech. Heron Power, the energy startup founded by former Tesla executive Drew Baglino, has raised a $140 million Series B. The company makes advanced electrical equipment for delivering power faster and more efficiently to projects like AI data centers. Drew is with us now here in San Francisco. We have been tracking Heron since its earlier days. This is, a quick Series B, maybe in succession to the fundraising you did already. But importantly, you bring Andreessen in through the American Dynamism Fund, a new investor. Let's start with that. Why go there?
First of all, thanks, Ed, for having me again on the program. I'm super proud to represent Heron on this major milestone today. We're focused on building new technology and manufacturing in the United States, and that's really aligned with A16Z's thesis through their American Dynamism Fund. And we just found alignment on our future vision of how we can revolutionize the electricity sector in the U.S. together.
In the time that I've known you, but particularly since you've been working on Heron, you've been pretty transparent. What you're trying to do is rethink a technology, essentially, and where it fits into modernizing grids, data center, the big energy capacity build out, which we'll get to.
Yeah.
Is there something more than just the capital that A16Z can help you with there?
They're an amazing firm. They've got resources across recruiting, in finance, in policy. They're great thought partners for us, along with our existing investor team,
right,
as we set off on this ambitious adventure.
So you're kind of still in R&D phase right now. Maybe just explain what Heron is and what Heron does, and then we can go from there.
Sure. What Heron's trying to do is take really 4 decades of innovation in power semiconductors that have happened in parallel to the Moore's Law improvement in transistors that are in compute, and bring them to the core of the grid. Right now, the grid is using largely mechanical devices that were invented like a century ago. And that is still what's underpinning everything in the power distribution sector. But at the same time, we've leveraged amazing improvements in power transistors, truly like orders of magnitude capability and cost reductions that have enabled all the innovation at the grid's edge: compute, consumer electronics, IT, communications. Right. We're bringing that to a sector that hasn't seen much change, which is the electricity sector itself.
You have made some commercial progress, basically. Even if you're in R&D phase, one of the case studies we've talked about previously is with Crusoe, which is in the AI data center context.
Yeah.
But just in layman's terms, where would Heron fit in the build out of a new data center?
Absolutely. So what Heron is doing is really three things for a data center developer. First, we're offering them like an alternative supply. Like right now, they're waiting for equipment that's largely produced overseas, potentially 2 or 3 years. We're building it at home, and we're building it with completely different supply chain that's way more scalable. No more steel and oil, replacing it with silicon and software. Second, we're simplifying what they need to build out. We're moving 70% of the gear on the way from the grid to the chip. That means less labor to find in the field, less time in the construction schedule. And the third thing we're doing is reducing the losses from grid to chip by a factor of 4, which means for the same power interconnection, which as we know can be difficult, you can produce that many more tokens.
Very quickly, what is the go live date? When is this going to be deployed commercially, do you think?
Yeah, we're going to deploy ourselves this year with early customers with revenue units in early 27 and then mass production in late 27.
Data center gets a lot of the focus. The other big story, which I think you'll appreciate, is what is happening with energy generation, energy storage, right?
Yeah.
Elon Musk has this 100 gigawatt solar goal.
Yeah.
You ran that business on the energy side at Tesla for a long time. You understand the reality of that number. Please also feel obliged, to jump in where Heron would fit in with that. But what do you make of that goal?
Oh, I think it's fantastic. I mean, globally, we saw over 0.5 terawatt, 500 gigawatts of solar installed last year, and that number isn't going to go down anytime soon. Really, the electricity sector is at a pivotal moment. Electricity has meant prosperity and growth for people all over the world for the past decades. But now it's at this juncture, right? We've got AI that needs way more power, and electricity, abundant renewable electricity, can be a path to an all-sustainable, all-electric energy economy. And to do that, we need more renewable energy, and we need more electricity.
Is 100 gigawatts in the United States achievable?
Oh, I mean, of course. If you put your mind to something, no matter how difficult it is, you can accomplish it. I can say that from 2 decades of experience scaling new technologies from nothing to, millions of units. Yeah, I think it's possible.
And that would be an addressable market for Heron?
100%. Yeah, we're going after solar, we're going after batteries, data centers, really anywhere where you need to go from DC to medium voltage AC. That's what Heron Link is for.
Drew Baglino, CEO of Heron, formerly, of course, of Tesla. Great to have you back here on Bloomberg Tech in San Francisco. Now, coming up, Mark Zuckerberg is expected to testify later today in a trial that's drawing comparisons to big tobacco's addiction reckoning. We'll discuss that next. This is Bloomberg Tech. Meta CEO Mark Zuckerberg is set to take the stand later today in a trial alleging his company's products and Google's YouTube were designed to addict young people, claims that both companies deny. Social media platforms, including Meta, are actually facing thousands of similar cases. That's in addition to claims brought by various state attorneys general alleging that these products cause harm in some way to users. Let's discuss with Sasha Hayworth. She's the executive director of the Tech Oversight Project, an advocacy group that urges reducing the power of big tech. And from the off, you're very much on the side of the alleged victims in this case, right? I think that's important to set out early. And there has been this criticism of big tech, but particularly the social media platforms, for a long time. In the context of this trial today, where Mr. Zuckerberg will testify later in the day, what's different this time?
Well, this is, as you alluded to earlier, big tech's big tobacco moment. It's the moment that tech accountability organizations like mine, as well as countless parents who have been touched in some way by the harms that social media addiction have caused, where we are going to see Mark Zuckerberg raise his right hand, take an oath before a judge and a jury of his peers, and for the first time explain to a court of law why his company knowingly developed products that targeted children to get them hooked, and then continued to feed them algorithmic content that did irretrievable harm. And what's different, because he's also told that to Congress, but he's going to have to explain why, despite telling us, the public, as well as members of Congress, that their products were safe for kids, why he systematically buried internal research and data showing there is a connection, and showing they did know that their products were addictive, and showing they did know that their products were harmful. So for many parents, this is the first step to hold big tech executives like Mark Zuckerberg accountable.
And what you just said, Sasha, Meta's response to this particular lawsuit is we strongly disagree with these allegations and are confident the evidence will show our long-standing commitment to supporting young people. Mark Zuckerberg is going to testify later today. Why is his testimony specifically significant? And what is it that the Tech Oversight Project would hope he's asked about during that process?
Well, the evidence has already shown that there have been many internal surveys, again, conducted by Meta, and in some cases partnering with external companies, survey firms such as Nielsen, to uncover whether there was a connection between social media overuse, social media addiction, or as the Instagram executives euphemistically refer to as problematic use, and harmful behavior. And there was, after about a week of not using social media, users reported that they felt better about themselves. They didn't have this compulsive need to pick up their phone. Their mental health improved. Instead of alerting the public to this potential health threat, they buried the research and never let it see the light of day, which is why Mark Zuckerberg can testify before Congress, claiming that the research is inconclusive. Another study that Adam Mosseri, the CEO of Instagram, had to explain the other day when he testified was something called Project Mist, which surveyed over 1,000 teens and parents. Again, showing that the parental controls, which big tech executives point to as one of the reasons why their products are safe for kids to use,
Sasha,
are essentially useless.
I appreciate a summary of the events of the trial so far. My question is, why significant that Mark Zuckerberg testifies later today, and what is it that you hope he is asked in that process?
Well, it's significant because this evidence has never before been seen. And he is not going to be able to say, Senator, I don't recall. Let my office get back to your office about that, and then walk away and never have to think about it again. This is a judge and jury. This is a court of law. The law comes for everyone. And if you have created a product that is unsafe for kids, that actually has been shown to kill kids, and you've lied about it to the public and buried research when you could have been warning us to the dangers, you're going to be held accountable. So that's why it's significant. He's never before had to answer to that. As far as the outcomes, I really hope that we see lasting policy change because of this. These are individual harms cases, so the individual outcomes might differ, but I hope that the U.S. Congress is compelled to act after these trials conclude.
Sasha Hayworth, Executive Director of the Tech Oversight Project, thank you very much. That does it for this edition of Bloomberg Tech. And what an edition it's been. There is a bit more calm in the market right now. There is a lot driving the markets in terms of news flow, and we got through a lot of that in the program. So recap it on the podcast. You know where to find it. It's on the Bloomberg terminal, as well as online on iHeart, Spotify, and on Apple. This is Bloomberg Tech.